everybody. We are back with one more corporate update. Happy to welcome in Minera Alamos President Doug Ramshaw once again. The stock got halted on Tuesday morning, and here it was. I see the halt symbol. I'm like, oh, the financing for Cerro de Oro must be finalized. And to my chagrin, no, that was not the case. We got a maiden resource for the Santana project. So here to talk about what the implications for that resource is, Dougie Fresh, Doug Ramshaw. Doug, welcome back.
Well, thanks, Trevor. And I really didn't want a halt. The problem is a maiden resource, even if it was 3,000 ounces, is material. And unfortunately, with IROC Geos having to review that, you can't have it out before 8 a.m. Eastern when they're kind of coming into their offices. So you have to have a very small halt. And I didn't plead with them, but I said, this is my message for IROC. I had thought that it had to be released at least 30 minutes prior to market open to avoid requiring a halt, so guess was mistaken. I hate having to halt if it can be avoided, as I certainly see companies, in my opinion, abuse halts for non-material news. We were forced to halt, but it actually gave time for people to kind of get up to speed with the contents of that release, and I'm glad that I was biting my fingernails not knowing which way this one was going to go, and I'm pleased that the market understood, at least today, the context of what we put out, this first iteration.
Yeah, so let's talk about the context of that, because if you just look at the numbers, it's not telling you the entire story. We'll just add that the stock was up 7.5% this morning. That was up 2 cents after the news, which actually, you and I were chatting before we pressed record, Doug, actually kind of surprised me, because if you were just looking at those numbers, you're seeing, about a little over 300,000 ounces total M&I and inferred coming from the three main deposits. That's Nicho Norte, Divisadero, and Benjamin. So, if you look at those numbers, it's not a lot of gold if you putting in context with a lot of big exploration plays. However, in the context of Santana, because of the cost to get Santana going, those are incredibly high margin ounces. And I think that's the context you have to remind everybody.
Yeah, the bulk of that resource, and we focus not on size, but confidence. So it's largely measured. It's a very high degree of confidence in those resource numbers. And so it wasn't about having scale. Honestly, give me 300,000 ounces right next to a mine operating site where you can turn those ounces into money quickly, and I'll take that over 1.5 million ounces in the middle of nowhere that still has to be built, the infrastructure and everything else. It might seem bigger, but if we're in the business of mining ounces that make money, I'll take these every day of the week. And arguably, let's say 200,000 ounces of those are recoverable over the next 5 to 6 years. And we're looking at, based on our operating performance in 2022, which is more reflective of the kind of operation we'd be imagining over the next 5 to 6 years at Santana. You're looking at ounces that are 500 US type margin. So suddenly a couple of 100,000 ounces of 500 US, that's 100 million US of operating cash flow. Future operating cash flow we presented in that resource today. And if we're, as an industry, should be in the business of making money, then that resource, which is only the first iteration, is primed to I think benefit our shareholders, benefit the growth of Santana regionally as we deploy cash flow from improved operations next year into more exploration. It's very similar to how El Castillo started out. El Castillo, I've mentioned so many times, when Darren and the team built it, was 350,000 odd ounces, and in 2 years it grew to a 1.2 million ounces. We built a mine at Santana because we see that regional potential being very similar in terms of overall mineral endowment. So I like the fact that we've shown people that we've got appropriate resource and mine life runway with high margin ounces that can be turned into cash to further expand Santana and other things that the company is doing. I'm pleased that the market understood that from that press release today.
So you talked about the mine runway, mine life. I mean, what are we looking at now? About 6 years in total? I mean, with the resource you have now?
About 5 to 6 years. Depends how quickly we scale it up. You know, we could mine it slower for 8 years, but you know, the reality was we were always looking after. You know, the goal is initially get it back up to about 20 to 25,000 ounces of annualized run rate, and then look to, in the next iteration of it, grow it to 30 to 40. You know, so 5 or 6 years is what was really presented today. That gives you a lot of time to deploy the drills and to be doing resource definition on other targets to effectively add mine life during this first 5-6 years.
So I want to talk about the economics here. I mean, what's not necessarily clear to me, Doug, is your cash costs. You do have the resource now, but how do we kind of start looking at how much it's actually going to cost you to produce an ounce of gold? We know, like we talk high margin, just because Santana alone it costs like $10 million to build, and obviously there's been some operational challenges that I think are in the past now, first half of the year. But when do we start seeing the actual costs for production?
Well, I mean, in 2022, you know, it's in our deck. Like through 2022's modest startup production, which was 12 or 13,000 ounces, our direct cash costs were just under 1,200 Canadian, so just under $1,000 US. And in terms of sustaining capital, it's limited to pad expansion, something that we're planning for at Santana that will allow us to raise the production rate there. And the costs again on pad, like the next phase of pad construction is a couple of $1 million. You know, that can be phased over 6 or 8 months. So we don't have huge sustaining costs. So I look at those direct kind of cash costs that we saw in 2022, which remarkably were in line with what we were thinking pre-COVID, pre-construction, that we really didn't see some gross inflation of our operating costs. I threw out 500 US as operating margin earlier, but I think that's conservative, but I'll still take 500 US an ounce in terms of margin for sure. And that's why I think, despite obviously the last week in the gold market, if you build projects which can work in whichever gold environment, these prices we're seeing right now are very healthy gold prices. I think, hopefully they go higher. There's more gravy for us, and I think it's better for the sector at large, obviously, to see money inflows that higher gold prices might prompt. But we built this business model to work in the $1,300 gold environment we were in when we started out. And we still, to this day, believe that these operations that we're looking to build in Cerro de Oro and La Fortuna, but also Santana, will cooperate very nicely and probably compete very nicely against our peers at much lower gold prices as well. And I think that's an important part of our business is, the gold sector is seen as such a cyclical one. Well, that's because we build operations that almost play to the cyclical nature of gold, and so they have their great years, and then they have some lean years or some bad years. We're trying to build a business model that can work in any gold price environment. I think the margin that we have on our ounces at Santana allows that.
One area within the project that didn't get mentioned in this resource, probably because it doesn't have a resource on it, is Zata. Just kind of curious what's the latest over at Zata?
So we got drill results coming out for Zada, and Benjamin had been historically drilled. That's why there's a little modest starting resource there.
Sure. Okay.
We said in the release that the plan was to do another 10 to 12 holes at Benjamin because we're still trying to figure it out. We'll have the initial holes out, I think, for both Zada and Benjamin later this month is probably the goal. But there's nothing that's going to stop us. At this point, we've made the decision to drill another 10 or 12 holes at Benjamin because we like it as a target. It's very close to the main center of operations right now. If Benjamin's even 80 or 100,000 ounces down the line, again, it's another couple of years of mine life that can be very rapidly drilled out. So there are some screaming historic holes at Benjamin. I think Miguel has been focused on trying to understand the system more than just drill barn burners. I did joke that in the next 10 or 12, then maybe you should be drilling some met holes down some of those historical holes, because it's got some really nice grade there, but we're still trying to figure it out. The regional prospectivity at Santana is very high, but it's going to need time to figure out these these other pipes, prioritize which ones should have more dollars spent, and they're perfect targets for cash flow generated from the starter Santana operations focused around the Nicho complex to deploy that capital to give our shareholders lots of self-funded exploration, which was always the goal of Santana.
Sure. Okay. Oh well, yeah, more to come here, but obviously the next news, I assume, is this financing package for the Cerro de Oro project. You mentioned that the due diligence is just kind of wrapping up here, so that funding announcement should be coming here imminently. I know you wanted to get it done. A couple, yeah. Well, you keep paying them, and they're just gonna take you for all you're worth, there, Doug. But yeah, we're coming.
Yeah, I mean, hopefully in the next week. I'd love to have news on that next week. I wanted to reassure people in this release that nothing's changed in terms of the business terms outlined in the May 31st release. This isn't like a PP that forever is extended and then doesn't close. This will close.
Right.
It's complicated because we're drafting things in two jurisdictions, Mexico and Canada. They are complex documents, more complex than people might think, and they have to be done right to protect both the lender but also us. And I think our shareholders would not want us to rush. They actually looked at some of what we were pushing back at times, which forces another turn of documents. It was disadvantageous for us. I think that they would prefer at the end of the day for a deal that is squarely rooted on a mutually beneficial relationship than us rushing to get something out to meet someone's impatience and causing problems down the road because we had an oversight on a drafting issue, which is actually, not very good for us. So we've been dotting I's, crossing T's with two sets of Canadian counsel, two sets of Mexican counsel, and I look forward to it being put to bed pretty soon.
Then they're going to stop invoicing you, Doug. All right. That's it. That's your update from Minera Alamos, everybody. They continue to be a sponsor of the podcast. I continue to be a shareholder, and they do trade on the Venture Exchange with MAI.